Welcome to the Radio Revenue Podcast. Last year, Nike made $46.4 billion. This year, they made the exact same amount. But behind that perfectly flat number, the company is quietly they're tearing their entire global business model down to the studs.
Yeah, it's pretty wild.
Slashing digital sales, losing massive ground in China, and, somehow paying for massive corporate layoffs with this lucky Supreme Court windfall.
It is the absolute definition of diagnostic muddy waters, because when you look at an annual report specifically, we're talking about the fiscal 2026 Form 10K for a company of this magnitude. You aren't just looking at a sneaker brand. You're really looking at a bellwether for the entire global economy. I mean, as of May 31st, 2026, Nike is just a $46.4 billion behemoth.
Which is just a staggering amount of money.
Oh, totally. And they're moving footwear, which makes up about 65% of their revenue. Then apparel is another 30%, and equipment is that final 5%. So across the globe, they are massive.
Yeah.
And while the total amount of money coming in didn't really change from 2025, the actual mechanics of the business, like the engine under the hood, has been completely torn apart and rebuilt.
Okay, let's unpack this.
Yeah.
Because for a listener like you, someone who loves learning and just wants a shortcut to being truly well-informed, we want to give you this ultimate peek behind the corporate curtain today.
Exactly.
So we're skipping the basics. You already know Nike sells shoes, apparel, athletic gear. What you might not know is how those products are moving right now. And, more importantly, how a flat top line is arguably the most deceptive number in this entire document.
Precisely. To understand the reality of their 2026 fiscal year, we really have to look past the $46.4 billion and look at the internal tectonic shifts.
The stuff beneath the surface.
Right. And the first major revelation in this deep dive is a massive and honestly somewhat humbling reversal in their sales strategy.
Okay, lay it out for us.
So let's look at the actual split in the data. On one side, you have Nike Direct. These are the sales made straight to the consumer through Nike's own physical stores and, their digital ecosystem.
The apps, the main website, all of that.
Yeah, exactly. For fiscal 2026, Nike Direct revenues actually fell 6%, dropping to $17.7 billion. And the truly staggering part, that decline was driven by a massive 12% drop in digital sales.
Wait, a 12% drop?
Yes.
But wait, for the last few years, hasn't the entire retail industry been just obsessing over direct-to-consumer?
Oh, completely. It was the only thing anyone talked about.
Right. So this feels like breaking up with your retail partners to go solo, realizing it's way harder than it looks, and then just crawling back to the group chat.
That is an incredibly accurate way to frame it, actually. And the numbers prove it, because on the other side of the equation, their wholesale revenues, the products they sell to independent distributors and those big retail chains, that jumped 6% to $27.5 billion.
But let me push back on this a little bit. I mean, is this some brilliant master strategy that Nike planned all along? Or are they just panicking because their warehouses are totally full of unsold inventory and the digital sales dried up?
What's fascinating here is how they spin it in the report.
Naturally.
They call this pivot their, quote, marketplace management strategy. But to your point, you really have to look at the why and the how of direct-to-consumer. During the peak of the DTC boom a few years ago, brands just loved the idea of cutting out the middleman.
Because you keep all the money.
Exactly.
Yeah.
You sell a shoe directly to a customer, you keep a much higher margin, but there's a massive hidden cost to that. You, as the brand, have to absorb all the logistics.
Right.
You're paying for the warehousing. You're paying for those individual shipping boxes. You are processing the returns. And most critically, you own 100% of the inventory risk.
Meaning, like, if an entire line of neon running shoes suddenly falls out of fashion, Nike doesn't have a retail partner who already bought them. Nike is just left holding the bag.
Right.
Or I guess the shoebox in this case.
Exactly that. If it doesn't sell online, it just sits in a Nike-owned warehouse costing them money every single day. So what the 10K details is a strategic and highly pragmatic retreat.
Yeah.
Nike wants their digital platform to be what they call a full-price platform. They want the prestige back.
Meaning no clearance sections on the app.
Right. If you log on to the Nike app, they want you seeing premium, full-priced, highly desirable items. But to do that, they have to clean house. The report notes they're actively liquidating their excess inventory by running markdowns in their direct channels.
Right.
But simultaneously, they're heavily reinvesting in wholesale distribution to clear out that inventory and create capacity for new products.
So they're essentially using the wholesale partners as a giant clearance rack.
Well, in a way, yes. They're using wholesale as a release valve.
Okay, that makes sense.
By shifting volume back to retail partners, your sporting goods stores, your mall retailers, Nike pushes that inventory risk off their own balance sheet. They sacrifice a little bit of the profit margin to get the product out the door.
Which frees up the physical warehouse space,
Right.
right? And the financial capacity to develop new stuff.
Exactly. It's an acknowledgement that the wholesale ecosystem is absolutely vital to manage the sheer physical volume of a $46 billion company.
That makes total sense when you explain the mechanics of the warehouses. I mean, you can't be the only club in town. You need the other promoters to help sell the tickets.
That's a great analogy.
But if wholesale is how they clear out inventory in places like the U.S., what happens when they hit a region where the whole marketplace is choked up? Because this strategy isn't playing out the same way globally, is it?
Not at all. Geography is really the second hidden narrative in this report, and the global map is deeply fractured right now.
Yeah, let's look at that.
If we look at the regional data, North America remains their absolute stronghold. It accounts for about 45% of their total revenue, pulling in $20.5 billion.
Wow.
And that is actually up 5% on a currency-neutral basis.
Mhm.
Europe, Middle East, and Africa, the EMEA segment, is holding steady at $12.5 billion. But then you look at Greater China.
Right, and that's where things look completely different in the report.
Drastically different. In Greater China, revenues were down 13% on a currency-neutral basis, landing at $5.8 billion.
Fudge.
And if you want a real shocker, look at Converse. As a standalone brand within the Nike portfolio, Converse didn't just dip. It cratered by 31%.
Stop for a second. Let's clarify some of this terminology before we get into that 31% drop, because my jaw is honestly on the floor right now.
Sure.
First, you keep saying revenues are up or down on a currency-neutral basis. Just so we're all on the same page, what does that actually mean when we're looking at these numbers?
That is a crucial distinction, actually. When a US-based company like Nike sells shoes in China, they are getting paid in yuan, but they have to report their earnings to Wall Street in US dollars. So if the value of the US dollar gets really strong compared to the yuan, the money Nike brings back looks like less, even if they sold the exact same number of shoes.
Oh, I see.
By looking at it on a currency-neutral basis, the accountants are basically stripping out the exchange rate fluctuations. It tells us the true underlying sales volume.
Got it.
So when we say Greater China is down 13% currency neutral, we're saying they are genuinely selling 13% less physical product, regardless of what the currency markets are doing.
Okay, that is incredibly helpful. So the actual volume of shoes and apparel moving out the door in China has just fallen off a cliff.
Yes, it has.
And a 31% drop for Converse. I mean, that's nearly a third of an iconic legacy brand just vanishing in a single year.
Yeah.
Why is Greater China, which has traditionally been this massive, unstoppable growth engine for Western brands, struggling so badly? Like, is this a product issue or is this an economy issue?
If we connect this to the bigger picture, the 10K spells out a perfect storm of macroeconomic headwinds.
So it's the economy.
Largely, yes. It's not necessarily that the design of the shoes is suddenly bad, it's that the environment they're selling in has fundamentally changed. The report explicitly states a trend of declining store traffic across Greater China.
People just aren't going to the malls.
Exactly. Consumers there are dealing with their own economic uncertainties, and they just aren't out shopping for premium athletic wear the way they were, say, 3 or 4 years ago.
And if they aren't shopping, that inventory trap we talked about earlier just gets worse.
Exactly. Which leads to the second problem the report highlights, which is elevated promotional activity.
Discounts.
Right. Because the shoes are just sitting there, the entire marketplace is choking on high inventory levels. Every brand, not just Nike, is discounting heavily just to get cash in the door.
Wow, so it's just a race to the bottom.
Pretty much. And when the whole market is locked in a discount war, a premium brand gets dragged right down into the mud with them. It erodes their revenue, it hurts their overall profitability, and worse, it damages the brand cachet.
Yeah, I mean, a premium brand loses its luster if it's literally always on sale.
Exactly.
So is there any light at the end of the tunnel there, or is this just the new normal for them in Asia?
The management commentary in the 10K is quite sobering on this front, honestly. They explicitly state they expect these negative impacts in Greater China and this strategic reset for Converse to continue throughout fiscal 2027.
Oh, wow, so no quick fix.
No. They aren't predicting a quick V-shaped recovery at all. They are buckling in for a multi-year slog to rebuild that market.
Man. So managing these international fires, shifting back to wholesale to empty out warehouses, trying to rescue Converse, these are massive structural changes.
Very massive.
And fixing a broken machine of this scale requires a lot of money. Which brings us to the financial price tag of this transition.
And that price tag is where we see some truly bizarre accounting realities.
Okay, here's where it gets really interesting. Because when you dig into the fourth quarter of 2026 data, there's this unbelievable financial plot twist.
It really is.
So on February 20, 2026, the U.S. Supreme Court made a ruling regarding certain U.S. tariffs. These were tariffs imposed under something called the International Emergency Economic Powers Act, or IEEPA.
Right.
The Supreme Court ruled that these specific tariffs were actually unauthorized. And because of that one legal ruling, Nike recognized a staggering $986 million benefit to their cost of sales, nearly $1 billion.
It is a phenomenal windfall. I mean, for a CFO trying to manage a flat revenue year, having nearly $1 billion injected straight into your gross margins in a single quarter is just an absolute dream scenario.
But how does that actually work mechanically? I think people hear legal ruling and wonder how that suddenly turns into almost $1 billion in cash on a balance sheet. Did the government just cut Nike a giant check?
No, it's largely an accounting mechanism related to how they calculate the cost of goods sold. Under IEPA, the U.S. government had levied specific import tariffs on certain goods entering the country. Nike, bringing in massive amounts of product from overseas, obviously paid those tariffs, which increased the cost of their inventory.
Right, it cost them more to bring the shoes in.
Exactly. So when the Supreme Court ruled those tariffs were unauthorized, it effectively meant Nike had been legally overcharged. The $986 million benefit represents the reversal of those tariff costs.
Oh, I see.
It instantly reduces their recognized cost of sales for the year, which artificially inflates their gross profit.
Okay, so they get this massive, nearly billion-dollar cushion.
Yeah.
But right next to that dream scenario in the report, there's a very harsh reality. In the exact same year, Nike reported $385 million in employee severance costs.
Yes.
The report says this was to realign their supply chain and technology teams. So I have to ask, did a Supreme Court tariff ruling basically serve as a slush fund to cushion the blow of a massive corporate layoff?
It's a great observation.
I mean, if you take away that billion-dollar legal win, does Nike's year look completely different?
That is the multi-million-dollar question, and you're entirely right to connect those two events. Let's look at the margins to understand just how vital that Supreme Court ruling was. For the entire fiscal year of 2026, Nike's gross margin only expanded by 20 basis points, landing at 42.9%.
Wait, 20 basis points, just to translate that into plain English, you're saying their overall profit margin on the goods they sold expanded by a microscopic 0.2%.
Correct, 0.2%.
That's nothing.
Now, think about the math there. They got $1 billion benefit to their cost of sales, and it still only moved their overall annual margin by 0.2%.
Wow.
When you are a $46.4 billion company, $1 billion gets heavily diluted. But more importantly, it shows you just how fiercely they were bleeding money everywhere else.
Right.
The tariff recovery didn't make them wildly profitable. It merely offset the massive operational costs and restructuring fees they were incurring.
Like the $385 million they spent on severance.
Exactly. That $385 million severance charge represents the very real human cost of a company trying to rapidly restructure to operate more efficiently in a volatile, inflation-heavy global market.
Yeah.
But notice who they are laying off: supply chain and technology teams.
The exact teams responsible for the digital sales ecosystem that just dropped 12%.
Precisely. They built a massive digital and direct consumer infrastructure, realized the inventory costs were crushing them, and now they're dismantling parts of it.
Yeah.
The severance costs are the painful organizational surgery required to fix the machine. But yes, to your point, without the Supreme Court ruling providing a $1 billion Band-Aid, the narrative around Nike's profitability this year, and honestly, Wall Street's reaction to it, would have been significantly more grim.
It's just wild to think about. A legal argument over trade authority in Washington, D.C. essentially funded the severance packages for tech workers out in Oregon.
It really does highlight the complexity.
It drives home how interconnected global commerce is. but dealing with import tariffs, bloated warehouses, and sweeping layoffs. I mean, that's just today's problem.
Right, that's looking in the rearview mirror. To see what they are actually afraid of regarding tomorrow, you really have to read the risk factors section of the 10K.
I find the risk factors section of a 10K so fascinating.
It's the best part.
It's the one place where corporate executives are legally obligated to list everything that could possibly destroy their company. It's basically a corporate doom scroll.
It is meant to be exhaustive to protect them from liability for sure, but if you analyze what they highlight and how they phrase it, it gives us a map of what keeps Nike executives awake at night.
Okay, so what's on the map for 2026?
Well, the risks that stand out are this fascinating mix of the hyper-futuristic and the intensely physical. Let's start with the technology side. The document explicitly warns investors that consumers, competitors, and retail platforms are increasingly utilizing artificial intelligence and machine learning.
So what does this all mean? Like, how is a company that makes physical objects, rubber soles, foam cushioning, knit fabric, genuinely threatened by AI?
It's a fair question.
I mean, it's not like an AI chatbot can 3D print a physical sneaker for you to run a marathon in.
This raises an important question about how value is actually generated in the modern economy. Yes, the ultimate product is a physical shoe, but the discovery of that shoe, the desire for that shoe, and the transaction of that shoe are entirely digital processes now.
Oh, that makes sense.
The 10K warns that if Nike cannot innovate its digital platforms or leverage AI at the pace of consumer expectations, their competitive position will slip.
Are they talking about AI designing better shoes or AI changing how we shop?
Mostly the latter. Think about the mechanics of online shopping right now. Historically, the Nike swoosh logo was a shortcut for your brain.
Yeah, you see the swoosh, you trust the quality, you buy the shoe.
Exactly. Brand loyalty was the ultimate filter. But AI doesn't care about a logo. It cares about data optimization.
Meaning, if I'm shopping on an AI-powered retail aggregator, and the algorithm knows my exact foot sizing, my pronation when I run, and, my historical aesthetic preferences.
It's going to curate a completely personalized storefront for you.
Exactly.
Yeah.
And if a competitor's shoe fits your data profile better, or frankly offers a better margin for the retail platform, the AI will serve that to you first.
Wow.
The threat isn't that AI will make a better physical shoe. The threat is that AI-enabled platforms will intercept the consumer before they ever even think to search for Nike.
So the algorithm becomes the gatekeeper.
Yes, and if that happens, brand loyalty to a legacy logo might begin to seriously erode. Nike has to be at the absolute cutting edge of machine learning just to ensure their products actually make it in front of your eyeballs.
That is terrifying for a company whose entire valuation is built on the cultural power of its brand. Like, the algorithm just becomes the ultimate tastemaker.
Pretty much. But what's so striking to me about this report is that right next to this invisible, hyper-advanced digital AI threat, they bring you violently back to the physical world. I saw a highly specific note in the risk factors about their Philip H. Knight campus.
Yes, their global headquarters located in Beaverton, Oregon.
Right. The report explicitly states that the campus is located in a known seismic zone, like an earthquake zone.
It's a remarkable inclusion that just grounds the entire document. We spend so much time analyzing digital trends, wholesale pivots, and AI algorithms, but Nike is ultimately bound by raw physical geography.
Yeah.
The report connects the dots for the investor here. They highlight how global climate change, extreme weather, and the literal physical threat of earthquakes pose massive supply chain and business continuity risks.
Let's walk through the mechanics of that because it's a domino effect, right? Like,
Right.
you have this incredibly sophisticated AI-driven global supply chain, but the physical ground shakes in Oregon.
The whole system can paralyze. Think about the chain reaction. If a major seismic event hits Beaverton, it's not just about the buildings falling down. The local server infrastructure might go offline. Executive leadership can't coordinate crisis response.
The central nervous system just goes dark.
Exactly. And if that nervous system goes offline, suddenly a manufacturing facility in Vietnam doesn't receive its updated design specs and production halts. A distribution warehouse in Europe doesn't get its shipping manifests and trucks stop rolling.
It's the ultimate vulnerability. I mean, a company heavily reliant on international logistics is only as strong as its weakest physical link.
Precisely.
They can outsmart the market on wholesale strategy. They can win a $1 billion tariff lawsuit at the Supreme Court. But a natural disaster at a key physical node could bring a $46 billion empire to a grinding halt.
They're balancing the ephemeral, invisible threat of machine learning intercepting their customers on one hand, and the very literal threat of tectonic plates shifting beneath their headquarters on the other.
Tectonic shifts in their global sales strategy and tectonic shifts under their feet. It really puts the scale and the fragility of running a modern global enterprise into perspective.
It certainly does.
You can't just sketch a cool sneaker and hire a famous athlete anymore. You have to outsmart a personalized algorithm, untangle international trade law, and apparently outrun a fault line.
Which leaves us with a final thought to mull over, building on the tension between the physical brand and the digital future that this 10K reveals.
I'd love to hear it.
We know Nike is fighting to keep its direct-to-consumer premium status while wrestling with AI, but as we move further into a reality where artificial intelligence begins to deeply curate our shopping habits, predicting what we want before we even know we want it, will a legacy logo like the Nike swoosh still carry the same cultural weight? Or will the algorithm itself become the brand we trust, rendering the logo on the side of the shoe completely secondary to the data that put it in our hands?
That is a phenomenal question. And honestly, one that every legacy brand on Earth is likely terrified to answer right now. It fundamentally changes what it means to be a consumer in the 21st century. We went looking for financial data in an annual report, and we ended up at the intersection of human behavior, physical logistics, and artificial intelligence.
That's the beauty of looking past the flat top-line revenue. The numbers always tell a human story if you know how to read the mechanics behind them.
They really do. And that is all the time we have for today's exploration. It was a Revenue Radio podcast. Thank you for watching. Please like, subscribe, and hit the bell to stay updated with our latest analyses.